Probably maybe take around 20 to 30 minutes just to set the broad context of how we are thinking through the current environment. Now, obviously, I mean, all of us are now worried about Trump's new taxes on India and all that. But if you look at the pattern, right, every time we spoke, there is always a new problem, and there is always the extrapolation of that problem. So I'm not going to take that route. I'm going to give you a framework which will not just help for today's problem, but whatever the new problems that come in, you will have a far more stable approach. Because if you really think about it, every 2 3 months you will get something or the other, and the usual template will be that now Trump has announced a particular tax, and then you figure out what is India's exports, and then you say what percentage of GDP, then you say within that what are the segments that get impacted, then you check what are the listed companies. So generally it's an extrapolation effort, and usually I have seen that unfortunately extrapolation doesn't work, because we assume that something is announced and then everything else stands still, but everybody adapts. So the companies will fight back. The Indian government will go and talk. So the key point is it's very, very difficult to, while it is more scientific to put extrapolation, but I realized that right from COVID, every time you did the extrapolation, it points you out in the wrong direction, and you end up missing a lot of the upside. So broadly, what we do is we have a very simple framework called identifying where we are in the cycle. Now, if we broadly look at the context today, we are probably down close to 10%. And then there is some bad news or the other. Today it is Trump increasing India tariff. But if you broadly put that 10% in context to history, the last 45 years of Sensex, each and every year there has been an intra-year fall, which means that while the year might end in positive, in the middle of the year, historically there has always been a fall. And what has been the extent of that fall? The extent of the fall usually has been around 10 to 20%. In fact, in the last 45 years, there were only 4 years where the fall was less than 10%. So which means every year had a fall. And for the remaining 41 years, you had a fall of more than 10%. And out of that, one of the year where the fall was less than 10% came in 2023. The other years was 2017, 2014, and 1984. So broadly, the fact that you will get a 10-20% fall every year is almost like a given. And in that context, if you see the current fall that we are currently at, we are somewhere close to around 9-10%. So in that sense, from a historical point of view, if somebody just looked at this year and said that are Indian markets more volatile? Absolutely not. This is, in fact, this is still one of the lowest volatile years. I mean, we don't know how it will pan out, but at least at this juncture, whatever you are seeing, both in terms of the bad news and both in terms of the market fall, is very, very, very normal. Now, the real problem is not the fact that it falls 10 to 20% every year. I mean, in fact, the other way to look around this is that while it falls 10 to 20% every year, almost 3 out of 4 years end up being positive. So, which means that 80% of the times, roughly, the year ends positive. So, which means most of these falls end up recovering very, very quickly. And in fact, COVID was a classic case where if you started on Jan 1st and then you slept off, by the end of the year, you are up some 16%. But however, in the middle of the year, your portfolio would have been down close to 40%. So that's the nature of the beast. And the key thing to remember is that most of these falls are very, very short lived. And by the end of the year, you almost end up becoming positive. So while every year you have a 10 to 20% fall, on a calendar year basis, almost 80% of the times you end up with a positive return. Now, this is the context. Now, what is the real problem? The real problem is not that I have a 10-20% fall every year, but I also know that once in every 7-10 years, I also get a very large fall, say close to around 50%, 60% kind of fall. And everybody is really worried about that, and the 10 to 20% fall is not a real problem. But the key question is that the 50% fall will also have to start from a 10 to 20% fall. So the real challenge is if I become complacent that 10 to 20% is almost a given, then that the real 50% fall also I will get hit with. But again, if I become too fearful, every 10-20% fall I will misinterpret to be the start of a 50% fall, and I will get out of the market, which is actually what has happened to a lot of people in the last 5-6 years. So net, This is the real challenge in terms of which is the start of a large fall vis-a-vis which is the regular normal fall. Now, obviously, there is no precise science to it because again, this is a probabilistic field. So the approach that we have used and it's kind of worked out really well for us is broadly to segment the markets into three phases. One we call the bull or the bubble or sorry, bull or the boring phase, which means that the markets go up sharply, then again get stuck there for some period of time. Then again they start going up, but over a 5, 7 year cycle, you find that you get very, very good returns in a bull market. And then comes a phase where the bull market, people overdo the bull market, where whatever is the underlying earnings growth, which is the fundamental driver of returns, the market ends up giving far, far more than the underlying earnings growth. So just to give you an example, in 2003 to 8, underlying earnings growth was 25%, but the markets gave you 45% CAGR or per annum returns. So those kind of excesses get built when markets go much ahead of the underlying earnings. So this is what generally leads to a bubble kind of a scenario where the valuations go crazy. A lot of other signals are there for a bubble, and this is where it is the most dangerous. So whenever you get into a bubble zone, any bad news, any temporary 10-20% fall becomes very, very dangerous because there is a very, very high likelihood of this being converted into a large fall. So think about this as somebody who is driving very fast vis-a-vis somebody who's driving at a normal speed. The same, somebody crossing the road may or may not lead to an accident depending on the speed, right? So similarly, the same negative event might end up creating a small 10-20% fall or create a large 40-50-60% fall depending on where you are in the market. So it's more like if the person is healthy, then a small virus can lead to a 1-2 day temporary fever and then you'll be sorted. But if the person is unhealthy, then the same virus can probably take you to the ICU. So similarly, it's very, very hard to figure out which event will hit when. But if you figure out the health of the economy and if you can figure out where we are in the cycle, then our decisions get a lot more easier. And then the last phase is after a bubble, it finally cracks at some point in time and becomes a bear market. Where again, if you have cash and a little bit of courage, generally we've seen historically, we've studied the last 45 years of history. And we've historically seen that whenever there is a 30, 40, 50% fall and you invested in 30% fall or a 40 or a 50, you always ended up making phenomenal money. So broadly, if you look at the three phases, 80% of the time you can roughly assume that you will be in a bull or a boring phase where essentially the idea is you don't need to do much. You just be allocated across different asset classes. And within equities also, you get broadly diversified. So the idea is not to take any crazy risks because either way, if you just stay on, you will make very, very good money. But the idea is to create a balanced portfolio for a bull market and not get overexposed to any of the segments. And as pockets of risk emerge, you kind of start removing that or reducing that. That's the a broad approach you take for a bull phase. And in a bubble phase is where you start de-risking your portfolio, probably reduce a bit of your equity, go up towards large caps, remove your illiquid part of your portfolio, move up the quality curve. And then in a bear phase, you just do the reverse where you increase your equity. You can go a little more on small caps. And again, you try to take more risks because that's probably the valuations are so cheap that you move towards the riskier parts and then you get rewarded for it. So this is the broad idea that 80% of the times you have a very balanced approach. 10% of the times you need to de-risk your portfolio and 10% of the times you again need to re-risk your portfolio. So this is what we call the 3B approach where bull, bubble and bear. Now the key question today is if we are in a bubble phase, then we need to get worried. But if we are in a bull or a boring phase, then it is still okay. Now the real problem happens that most people misdiagnose a bull market to be a bubble and mostly they get out a lot early and miss the entire bull market. And the reverse can also happen that you get too complacent that you think it's not a bubble, but it is a bull and hence you get caught in a large market fall. So if you get a rough sense of where you are in the cycle, broadly we are through. Now the easiest phase to identify is the bear market because generally you are down 20, 25, 30%. And usually that will be accompanied by all the other global markets also going down. It's very, very rare that India alone goes down 25-30%. So generally bear phases are I mean, numerically also it is super easy to identify a bear phase. So today we are nowhere close to a 20% fall. So we are not in a bear phase. Now the real challenge today is, are we in a bull boring phase or are we in a bubble phase? Now, how do we figure that out? See, one of the mistakes that I've done earlier in my life is there will always be one indicator which will be negative. So somebody will say P is, I mean, like in 2008, 9, 21 times P used to be the number which brought the fall. So after that, whenever the P became 21 or 22, people would say that in 2008 it went to 21 and then it fell. But again, so what really happens is that you cling on to a single metric without putting all the other metrics into context, and mostly single metrics lead to wrong decisions at the wrong time. So I've realized that generally to call for a bubble, I mean, as such, it is very hard. But for you to get into a de-risking mode, a lot of the indicators will have to point towards a bubble. But if it's only one or two, then you don't need to worry. But generally, a bubble means the excesses are evident through different lenses. So what we do is just like the Indian story where five blind men are touching the Indian elephant from different parts. Somebody says it's a snake touching the tail, and somebody says it is a fan touching the ear, and somebody says it's a wall touching the body. So we don't want to get into that error of picking one isolated metric and then judging where the markets are. So what we do is we have a framework called the five blind men framework, where we look at five different lenses. So the first lens is we purely ask on a valuation side, where are we? And generally we look at the large cap, the top 100 index, because again, unless and until the top 100 also becomes insanely expensive, it's very hard to call for a bubble. There will be periods where small caps may get into a very expensive territory, but to call for a broad market-wise bubble where the overall markets will crash by 50%, you need the large caps to also become very, very expensive. So generally, in all these frameworks, you broadly start with the large caps, and for small and mid caps, you do a separate isolated framework. But we are only bothered about the big numbers that at a broader level, is the market getting very dangerous or not? So the first lens we use is valuation. The second lens we use is where are we in the earning cycle? Are we in the early, mid, late? Generally, we get worried in the late cycle. And then again, the third thing that we look at, what is the demand and supply showing? Demand basically means who is buying, what are the FIIs doing, what are the DIIs doing, and what are the promoters doing. Now, supply can come from promoters, and demand mostly comes from either the FIIs or DIIs. So basically, you are looking at what is the demand supply equation. And the fourth thing you're looking at it broadly the sentiments, which means are people acting very greedy or are people acting very fearful? And there are different metrics to look at that. And the fifth one is if these four are extremes, so very high valuations, we are in the late part of the earning cycle, there is too much demand and the supply, and there is too much promoter selling, like both FIIs are positive, both DIIs are positive while the promoters are selling. That is a negative signal. And then the fourth one is there is extreme greed. Now, when all these four come together, it becomes very dangerous. But again, these four are just not enough to burst the bubble. You still need a pin to prick the bubble. So for that is what we call the trigger. And historically, when we studied all the bubble markets, how they broke, usually you needed one of the four, which is one, there is a political uncertainty. Or there is some politically it is unstable and there is crazy policies. So this is one. And two, there is leverage in the system. Either banks are over leveraged, which means basically somebody in the system has taken too much of loans. Either it is banking, which is very weak, or it is the companies which have taken a very high debt, or it's the government, or it is households, which is us. And the third part is there is weak macro. So either you are running an inflation problem, current account problem, fiscal deficit, growth is slowing down, or there is a currency problem. So some part of the macro becomes very, very weak. And the last part is some unpredictable thing happens like war, COVID, which is obviously it is unpredictable. So that anyway you can't bring into the framework. So broadly you look for political instability or policy, erratic policy making, like what you're seeing in the US, and then or what happened in China, and then the leverage, and then the broad borrowing part of the market, and then you look at the weak macro. So out of these three, if any of the triggers are there, then you broadly call for then you know that the bubble may break any point in time. So under these five, the idea is, where are we today? Now, in a nutshell, how do we look at these? Think about valuations as your speed. So the higher the speed you go, the more dangerous it is. Your earning cycle is your fuel tank. If the fuel tank is full, then you have a long way to go. If the fuel tank is near your reserve, then you have a shorter way to go. So that's how we look at the earning cycle. Flow is equal to traffic. More traffic, it's a contraindicator. So more the traffic, the worse it is. Similarly, the more the flows, the worse it is for us. Then the sentiment is basically you're drunk and you're driving. And then the trigger is some dog or some cow suddenly coming in the middle of the road. So all these five, this is how we look at it. Now, in a nutshell, what is the final view that we have got? We think we are still in the middle of a bull market, and probably we are going through a boring phase where in the middle of a bull market, the markets get stuck for 2 years. The same thing happened in the period around that 21, 22 also. You found a 1 year kind of a stagnant period. So these are very common in bull markets. Now, how did we come to the conclusion? Level one, we look at valuation. So for that, we have we have 4 indicators: price to earnings, price to book, market cap to GDP, and we have earnings yield, which is basically we compare the inverse of P, which is effectively we look at the equity market valuation and compare that with the debt market valuation. So it's called the earnings yield to what is the GSET yields showing. So all these 4 we combine into a single metric so that we are not getting skewed by any one of the metric. And broadly, that number goes anywhere between 0 to 100, 0 being really cheap and 100 being very expensive. So today we are at 60, which is the neutral zone. So totally, if there are 5 bands, we are exactly in the middle band of 3. So at 5, it becomes very expensive. At 2 and 1, it becomes a no-brainer to buy. In fact, in the last correction, we almost touched the cheap zone, which is the second band. We were at 50. So had it gone to 49, we would have gotten the complete signal. But yeah, this is a fairly good metric that has worked reasonably well. But again, this does not work in isolation. You'll have to put it in context. So level 1, what is the blind man who is touching valuations telling us? That at least on the large cap side, the valuations look okay. And the other way to confirm this is you can look at the BAF models. You can look at ICICI, Birla, you can look at, and there are different, UTI AMC publishes a similar kind of a model. And then there is Union AMC, which again publishes. So most of them are kind of showing a very similar trend that the valuations are neutral. So again, this can be used to confirm that your model is not getting something wrong, and is it broadly in line with the other big AMC. So in a way, you're also outsourcing your valuation model to others if you can't build something on your own. But make sure that you are going through at least 3 or 4 different AMCs so that broadly you know that you are in line. So in that sense, almost every model, all of the models might be different, but broadly everybody seems to agree that we are not in any extreme valuations, at least on the large cap side. The second thing that we look at is a very, very simple metric, like what is the earnings and what is the returns. Generally, as I told, in 2003 to 8, for a 25% earnings, you got 45% returns. So which means for a 3x in return, in earnings, you ended up getting 6.5x, which is why after that you found a 50% correction. So the first question that you always ask is, what has been the last 5-year earnings growth? Now, the last 5-year earnings growth is close to 16.7% for Sensex, which is roughly rounded off to 17%. And the good part is that the Sensex returns have also been 18%. So for a 17% earnings growth, we have ended up getting 18% returns, which is perfectly normal. Now, had we got, say, 28 or 30 or 35% returns for a 17% earnings growth, then today this indicator would have said that you have to be extremely cautious. But while 18% looks like a big number, but the reality is that the underlying earnings growth have also been very, very strong. And it's been close to 17% for the Sensex. And again, the next question to ask is, okay, at least in the last 5 years, there has not been any excesses getting built at an aggregate. But the key point for us is next 5 years, what should be my rough earnings growth? And then based on that, I can decide whether I need to continue and where are we in the cycle is what will get decided by that. Again, we generally avoid looking at the current quarter numbers because it always ends up misleading because there will whenever there is a problem, it looks like it will continue and there is almost no sight ahead of time because anybody who studied the quarterly earnings in COVID would have no way guessed that the next 5 years you would end up making 17% earnings growth. So we have realized that seeing where we are in the cycle, at the same time, if you instead use this metric of PAT to GDP, that generally for listed companies aggregate, it goes anywhere between 2 to 7%. And if you look at the year before COVID, the number had gone as low as 1.6% to 2%, right? So at that point in time, you broadly know that you don't need to check the quarterly earnings, but broadly, the cycle is by your side. You are in the early cycle and you don't know what is the trigger that will turn around. But in those levels, you just wait for 5 years, you'll more or less the earnings will catch up. So again, we are today definitely not in 2% zone. We are somewhere around 5%. But my sense is the cycle might end somewhere close to around 7% because this is a cycle where the credit growth, which is the loan growth, has not yet started. And the capex cycle, which is effectively companies putting capex, that is also not started. Because if you look at the capex cycle, it goes, the gross fixed capital formation is a good metric to roughly gauge that. It goes anywhere between 26% to 36%. From 27% in FY21, we are somewhere close to 30. So which means that we are a very, very long way away from the capex peak. And then again, if you look at credit growth, we are roughly around close to 10% band. Now, generally in the peak of the cycle, it comes anywhere close to 25 to 30%. In fact, last time peak, it was 36%, but at least 25 is like a very, very, extreme kind of a number. And then again, the other thing you look at is the ROE of companies. At peaks, it's somewhere around 25%. Bottom, it's somewhere around 10%. Today, it's close to 18%. So you look at all the metrics, PAT to GDP, ROE, loan growth, gross fixed capital formula, everything is exactly in the middle. And roughly, if you put the math saying that today we are at 5.1%, and let's say it goes to 6% over the next 5 years, and you get a nominal GDP growth of 10 to 11%, that means the earnings growth is roughly around 13 to 14%. And let's say instead of 6%, if we go to 7%, that can bring the rough earnings growth to 17 to 18%. So broadly, we are still in a very decent earnings environment, while obviously the 17 to 20% earnings might become a little difficult, but at least a 13 to 15% kind of a band seems to be reasonable to expect, at least based on where we are in the cycle. Now, what will exactly happen? How will it exactly pan out is very, very difficult. And if you look at the quarterly numbers and then try to figure out how this will happen, we will again get it wrong because we will always extrapolate. There will always be some problem. And if you historically look at the previous bull market also, it's not like every year you got the earnings. There was an intermediary lull in the quarterly earnings, and this is a common phenomena. So which is why we find that the moment you have a 5 to 7 year time frame, that in itself puts almost 80% of the times you made more than 12%. And if you get a decent fund, like say HDFC Flexi or Franklin Flexi, we've studied a lot of funds in the last 25 years. There's almost a 97% odds that you end up making more than 12%. And almost 50% of the time you actually ended up making more than 18%, right? But okay, at least historically it was much higher. So even bringing it down, I think broadly, if you just give it time, the odds are insanely by your side. And on top of it, if you get the broad earnings cycle right, the odds are insanely by your side. So today the earnings cycle is clearly indicating that in the past 5 years, there has not been any excesses getting built. The next 5 years, we look to a reasonable band of 13 to 15%. Obviously, there'll be certain companies which will do much better, but at least the broad setup seems to be pointing towards a 13-15% kind of an earnings environment over the next 5 years. And then, so that is the second lens which is showing that we are still not in the late cycle. and then we might need to worry, but we are still in the mid cycle. So valuations are okay. The earning cycle is somewhere in the mid cycle. The last and the third part we look at is demand and supply. DIAs have been crazy. The DIA flows are very, very, very strong. But the good part is that FIAs have hardly participated. So if you look at the last 3.5 years, FIA flows are still negative. So for almost last 3.5 years, the FIA flows are negative half a lakh crores. At the same time, we have almost brought in 14 lakh crores. And historically, FIAs comfortably get anywhere between 1 lakh to 1.5 lakh crores. And at least for this market, so which means like almost in the last 3.5 years, they should have roughly brought at least 3.5, 4 lakh crores. But in fact, they are negative half a lakh crore. So one large buyer has been completely negative on India for the last 3.5 years and has missed the entire, almost a large part of the bull market. In fact, they've been negative right since 2021. So with one large buyer being extremely negative, it's very, very hard to call for a bubble, because generally in a bubble, it means that everybody on the street is positive and everybody is convinced that India will do extremely well. So in that context, again, as you see, FIAs are negative, while DIAs are very strong. So if both have been very, very positive or very, very extreme, then I would have been worried. But the fact that one of the largest buyers of Indian markets has been negative and has not participated in the last 3.5 years is a positive indicator for me. Again, if you historically look at it, whenever FIA flows became negative on a 12-month basis, the next 2 to 3 years, you always ended up making between 15 to 20%. And again, that has happened between Jan to April this year. So which means that going by history, because generally the logic is FIAs will again come back. So FIAs coming back is probably something which nobody is still factoring in. But if they come back at some point in time, which I think they will, it's very hard to predict when, but at some point in time, if they come, that can become a very, very large source of a new demand. From a DIA standpoint, it is a very large number, but again, a large part of it is supported by SIP flows, which is almost gunning close to 28,000 crores. So if you roughly, and I'm sure it will get to 30,000 crores in some point in time. So that in itself is roughly somewhere close to around 3.6 lakh crores, right? So that is becoming a very, very,
Arun,
hello.
Arun,
Yeah.
sorry to come in between. I think there was some echo on your end. I think let me mute my side and see if
Yeah.
it's work fine
Yeah.
now.
Is it better now?
So there is little echo, not sure.
There is a
Previously
little.
it was fine, but last 30, 45 seconds since when you were talking about the FIIs,
Okay.
it's kind of
Is it better now? Now? Or is it the same?
little better. You can continue. We in case there would be any issue,
Okay,
I'll
one
come
second.
again.
I'll just plug in, then I'll. Hello. Now I'm audible, right?
Yes, yes, you are.
Yeah, one second.
I mean, it was perfectly fine. Last 30 seconds or maybe a minute, we lost. Lost in the sense it was a little.
Yeah, so now is it clear or is it still the same?
Maybe we can see in the comments the other participants can. I'll manage if they are okay. Let me see. One
Yeah,
moment, please. I think it's fine, Arun.
it's
We
fine.
can
Yeah, yeah.
continue.
So broadly, I was just saying that the FIA flows are negative for the last 3.5 years, and historically, when they are negative on a 1 year basis, you've always made money in the next 3 years because they generally tend to come back, and that signal has again happened in the last 3 to 4 months. Sorry, from Jan to April, that signal again has happened, and in fact, we are still in the negative zone. So, which means that again, from an FII angle, it means that it's a good indicator, a contra indicator, which generally has led to very, very. It's happened 6 times in the past, and all the 6 times you made money, and this is the seventh time it is happening. And again, FII ownership is at 14-year low. The dollar is weakening. And despite all this, India has been the best performing market, even in dollar terms, for the last 20 years. So putting all this together, very hard to build a case that FIs won't come back. So anytime there is a correction or at some point in time, they will eventually have to jump back. The good part for them is that US has done extremely well, so they haven't missed out anything. But there are also a lot of voices that they will have to start moving out, or not moving entirely out, but even they will have to start de-risking from US a little bit at least. So even a small amount of money which moves away from US can be a very, very large inflow to emerging markets. So that can be a trigger, but obviously it's very hard to time all this. And then again, on the DIA side, while SIP flows is very, very strong and it's a very stable component, the good part is that all this being said, we are still only, equities is only 6% of the overall Indian households assets. It was when they started, it was somewhere close to 4%. Now today we are at 6%. So while the numbers look very large, it is just 2% more. But otherwise 50% is still in real estate, 15% is in gold, another 15% is in bank deposits, another 6% is in insurance. Then there is PF of another 6%. So effectively, if you look at it, we are still 80% of the assets is still in real estate, gold and real estate, gold and fixed deposits. So we have barely scratched the surface. So in that sense, while the number historically looks like a very high number, but if you put that in context of the Indian households overall wealth, it's just barely a move from 4 to 6%. And a similar trend had happened in US during 1980 to 2000. Where again the retail MF penetration went from 6% to 46% of households. So and then as S&P, I mean the US markets had their biggest bull market during that period. So broadly, I think DIAs, while it is the flows have been very, very high, but again from if you take a slightly longer perspective, we are barely scratching the surface. So putting all this together, we are in a good place. FIAs are negative while DIAs look a little more structural. The real challenge today is that the supply is also coming. In the middle, it had slowed down. The supply has increased dramatically, both in terms of IPOs and most importantly in terms of the promoter VCP selling. But again, you can't paint everything with the same brush because historically, if you look at it, if you look at all the companies where the promoters sold, in fact, 50% of the companies actually delivered more than 10%. And almost 15% of the companies delivered more than 30% returns. And same thing happened for PEV. So it is not fair to say that all promoter selling leads to poor returns. But again, it is a very important indicator. So in the near run, in fact, for the amount of DIA buying, we should have seen a much higher market. But thanks to all this supply that most of them is getting absorbed. So I think broadly the direction of the market in the near run will be a matter of DIA flows plus FIA flows on the demand side and the promoter or the PEVC selling or the IPO flows on the other side absorbing them. And as long as the equation is balanced, the markets may get stuck for some time. But the day this equation, again, the supply reduces and the demand is very, very strong. The supply, for some reason, if it reduces, then again, the markets can shoot up very, very sharply. So which is where the FIA flows can be a very, very a big move maker in the next 1 or 2 years. But again, it's very, very hard to predict it. But this is something that will really determine the near-term market movement. So that's where we are on this is the only negative indicator that we are seeing, that the promoters and a lot of private equity VC firms are exiting. And finally, on the sentiments, there is something which SBI publishes. SBI Mutual Fund they publish every month, and that is also showing a neutral indicator. And again, broadly, if you look at the VIX indicator, it went to the fear zone, but now it's again back to very, very complacent levels. Broadly, it is okay. It's not too greedy or neither is it too fearful, because in greed times, the last 1 year returns become crazy in a bubble, and generally the small cap sector investments go crazy. Today also it is at 30% of the inflows, but I mean, it can go to 50-60% when it becomes really crazy. So overall, it's not like there is no greed, but there are in pockets, but at an aggregate level, it still seems to be like an okay market. So overall, 4 things put together: valuations are okay, earnings cycle, we are still in the middle of it, FIAs are negative, DIAs are positive, supply is coming, which is the only clear red signal. And otherwise, on the sentiment, there is no extremes getting built. And lastly, if you look at triggers, absolutely no problem on the macro. So very low inflation, growth is decent, current account deficit under control, fiscal deficit is coming down. So this is probably the best macro that India has ever seen. There is no leverage in the system. Companies are at 15-year low debt. Banks are clean. They've not lent at all. So they've cleaned up the balance sheets for the last 10 years. So banks are super clean. Probably some areas of microfinance might get into a problem. But otherwise, the broad big banks are, the credit cycle is still not started and they are very clean. The government is also reducing fiscal deficit. And then again, households also, while the debt is increasing, it's still very, very low compared to any other global country. So overall, there is no signs of a leverage problem. Again, politically, while obviously BJP didn't win the entire majority, it still looks like they're okay. It's not like it's an unstable or they're not allowed to make decisions. So broadly, there are no common triggers for a bubble. So effectively putting all this together, our sense is that we are somewhere in the middle of a bull market and mostly going through that boring phase where the markets will become stagnant for some period of time. Then suddenly they will shoot up. So that is where we are. So in a phase like this, our broad idea would be that any large correction, say 15-20%, will have to be bought into. And the probability of that converting into a 40-50% correction is very, very low. The bad news will keep changing, but if you keep tracking the bad news, it will become very, very difficult because you will obviously extrapolate that and then you will get out of the market and then it becomes very, very difficult to get back in. Now, what can be the near term triggers? Again, RBI has completely reduced they've gone for rate cuts. The liquidity RBI is gone all in. So they've done everything they can in terms of stimulus. The last time budget, again, there was a tax cut for all of us. Then there is a eighth pay commission which will come up from Jan 2026. Oil prices are okay. The dollar is also weakening. And then there are early signs that private capex is picking up and it is also getting a lot more broad based. The government capex is anyway being decent, while obviously they will kind of start slowing or it can't increase from here on. The private capex will have to start taking the baton. So again, it's not reflecting in credit growth because most of the corporates have a lot of cash in their balance sheet. So overall, our sense is that we are still somewhere in the middle of the bull market and mostly we might go through a stagnant phase for some period of time. And the near term, it will predominantly be what the demand demand by FII plus DII minus your supply, which is your promoter and PE selling. So this will only determine the next probably 3 to 6 month direction. But again, broadly for somebody taking a 5 to 7 year view, I don't think there is any broad concern on the market. So our framework is telling us that again, this is a time where you create a balanced portfolio, be split across equity, debt, gold. And within equity, don't go overboard on small and mid caps because there we are seeing signs of excess valuation. Well, obviously, till the flows are very strong, it's very hard to bring that segment down. But we think that don't go overboard on small and mid caps. Probably a 70% large and a 30% mid and small should be fine. But I see the reverse in a lot of portfolios. 70% mid and small and 30% large is a very dangerous place to be in. So the idea is in a bull market, you be balanced and then you just navigate it, figure out where the risks are emerging and try to keep it controlled. And you don't need to go zero or all in, but basically try to make sure. So I think the risky part of the market is in mid and small. So there you kind of reduce it at an overall portfolio level. But otherwise, the large caps look okay at this juncture. So and the return expectation, obviously, the last 5-7 years, most of us have seen 18, 20, 25%. 18, 20% kind of returns. That may need to get pared down. But I think we are still, compared to any other asset class, it still looks like you will get a very decent experience over the next 3 to 5 years. So this is where we are currently, and Prince. So this is what I just wanted to communicate.
Perfect, Arun. All years I've been listening, and it's always great. Arun, quick question, although you already touched upon the asset allocation. So primarily, like most of the people are clueless about their asset allocation and portfolio construction. So some thoughts around that, if you can, would be really
Yeah,
helpful.
see, the broad idea is that, see, as I told, historically, if you just hang on for 7 years, there is an 80% odds that Nifty 50 will deliver you more than 12%. And if you get a decent fund, the odds almost go up to 90-95%, right? So effectively, the real number one lever that all of us have is how do we stick for 7 years, right? And SIP is again a great tool because you are not getting caught in one today's valuation. But let's say you're running it over a 7 year, 10 year cycle, you will, I mean, somebody who would have done it in 2020 till today, they would have got it in 2020 start, then at the 40% fall, they would have gotten. So if you're an SIP investor or if you are a salaried person with a long runway, then you don't need to worry about all this frameworks and all that. Anyway, you will be averaging it out across your life, and so you will be through. But the key point is, as I told, if you just get the 7 year time frame done, most of your problems get sorted. So in that context, if you really look at it, the next lever that you can apply is that instead of doing 100% pure equity portfolio, I mean, all this I'm saying that once you get a reasonably large size, but in the initial phases of your life, you will realize that, let's say I have a 10 lakh portfolio. Now, how much ever asset allocation I do, and let's say I am doing a 30,000 rupees SIP. So, which means that in the next 1 year, that 30,000 rupees monthly will imply 3,60,000 per year as the additional savings. So, which means while my portfolio, if even if it is 100% equities, whether you like it or not, by the next year, I'm adding one more 36%. So even if there is a large bear market in the next 2 years, I will be adding almost close to 70% to my portfolio. So even if you do 100%, initially, it really doesn't matter. It really starts pinching you once you realize that your incremental savings comes less than say 10% of your portfolio. In that sense, asset allocation becomes important because there what you are contributing and what your because let's say your portfolio is doing 10%, then you are also adding 10%. So which means your portfolio is almost acting as equivalent as you because you are going to work, you are doing all the struggles and then you are only able to add 10%, while your portfolio also doing the same. So then your portfolio needs to definitely follow an asset allocation. But when I say asset allocation, for mostly if you are very young and your savings as a percentage of your portfolio is very, very high, then don't even bother about it. As long as it's above 15%, then don't even bother about it. But the day it comes to 10% is where you start doing asset allocation. And in there, it's just a very simple thing that you add some bit of debt and gold. So what we have seen is that a 70% equity with 15% gold and 15% debt gives you a very, very good experience without compromising on the returns. If you look at the 20-year returns, it's almost ditto the same. 100% equity, whatever the returns that you have got. So roughly an equity in Nifty 50 gave you 14% returns, pure equity. And if you look at the equity 70, debt 15, gold 15, that almost gave you 14.4%. So you've got slightly better returns. And the best part is that the worst downside for a pure equity is close to 60%, while for this asset allocation portfolio it comes down to 40%. And again, on a 7 year basis also, more than 12% returns is almost the same. You get a 63% chance of making, sorry, on a 7 year basis, you get a 65% chance of making more than 12%. And for pure equities, it's almost like a 70%. So it's almost the same. So all I'm saying is that once your portfolios become big, you will need to have some bit of equity and debt. And it's not like you will have to compromise on returns. The returns are more or less the same, but the impact of declines reduces dramatically. And the second most important point is that it allows you to re-risk during a market fall, because otherwise if the market falls say 30, 40, 50%, and your incremental savings is also very, very low. So let's say I'm only adding 5%, then there's hardly anything that I can do to move my portfolio. But if I have 30% with me, which I can move into equities at a lower valuation, that can be phenomenal because, and it'll also help you to navigate a bear market better. So overall, from a context of navigating a 10-year cycle, asset allocation makes a lot of sense. And the key point is a lot of us are worried that it'll lead to a lot of compromise in returns. But the data shows that there is not much of a return sacrifice, but at the same time, it reduces your volatility dramatically. So all you need to do is keep an asset allocation of 70%, or whatever. You can fix it based on your risk profile. But broadly, we've seen that at 70% equity, 15% debt, and 15% gold, and you keep rebalancing every year. If any of the asset class or goes above or below by more than 5%. So the 70 becomes 76 or becomes 64, which is more than 5% deviation. Then you bring it back to the original. But otherwise, it's a very, very simple construct. And most importantly, this makes a lot of sense provided your portfolio becomes large enough. But otherwise, if you're just starting it out, then even 100% equity doesn't matter, because net, the debt portion is actually your incremental savings. And for most of us, I've realized that in the first 10 years, the incremental savings as a percentage of portfolio which is getting added is very, very large. And so don't overcomplicate your life in the early stages. Asset allocation comes only once your portfolio becomes meaningfully large.
So, Arun, any study or data backing, like majority of the participant, I can say they are doing their investing majorly without any framework or any set process, right? And there are very few disciplined people who properly follow or maybe do it systematically. So, any data or maybe anything which can broadly tell our audience that they are doing a big mistake by not doing it via some framework, or to say a set process rather than vaguely doing on whims and
Yeah.
fancies, be it direct equity or SIPs and whatever.
Yeah, I think at least I can tell this from a personal experience that, I mean, initially, like all of us, like I also started as a stock investor. I used to do a lot of stock picking, and like I was into it full time. Like I was technically a part of the research team for a large wealth management firm. So we were doing this day in, day out. We got access to good fund managers. We got access to Bloomberg. So you name it, we had it. I mean, I was doing it almost for like 3-4 years, and we used to discuss it. It's a lot more fun. It's a lot more exciting, obviously. But the real eye opener came when we realized that our ELSs, when we invested in our ELSs, which was obviously we did it for tax. But at that point in time, I was like, I mean, this is an unnecessary thing. I would have easily bet the ELSs, but anyway, we don't have a choice, so we put it. But at that point in time, the notion was mutual funds or any a stock basket as a concept won't do as well as us individually picking stocks. But then I realized after 3-4 years that with almost zero effort, right, that ELSS was giving a very, very, very good return compared to my lousy stock return. So I think at level one, I mean, I'm not saying all of you have to be as bad as me in stock picking. But the key point I've seen is that a lot of us do not actually measure our returns. A lot of us end up spending a lot more time. So one, your time has some value. And for that value, had you put it in your own field, let's say you're a doctor and you can put, or a software engineer, and you can put that into some AI course, and that will mean that your salary goes higher and your savings can be higher, because the alpha that you can get by increasing your savings from say 30,000 to 40,000 or 50,000 is usually much, much higher than incrementally getting a 10% extra return. So the key thing I think everybody has to do is, one, start measuring your overall portfolio returns, saying that if I didn't do this, and had I simply put in a Nifty 50 or a Nifty 500 index fund, what would have been the returns over the last 3 years, 5 years? And for taking all the extra effort, have I been able to beat it? And then you say, with respect to some decent mutual funds, would I have done better? Now, if unless and until you are meaningfully doing better, otherwise I think, and you put together the time that you spent on that. Mostly, and I mean, at Funds India, we have a tool which provides investors with the immediate returns that what they've done. And mostly I've seen that a lot of people end up underperforming the index. But the key point is, none of the brokerage sites, none of them actually give you that comparison, because obviously if they give, then we will all stop doing it on our own. So I think the first thing that you do is honestly start tracking your performance. do it at least once every 6 months, and most of you will realize that if you do that exercise over a 1 year, 2 year time frame, you will kind of realize that probably I'm doing too much effort and the results are not showing up. So this is level one. Level two is that how do you the key mistakes that I've seen. So one that and the key idea is how do you put the least amount of effort and then make a lot of money at the end of it. Now, stock picking obviously is a lot more time consuming. So it's easier to outsource it to either a mutual fund or a PMS or an AIF. But I mean, personally, I like mutual funds. But anyway, the broad idea is you outsource it to a fund manager. And the key idea is how do you pick fund manager, right? So there are three problems that happen. One, you look at past performance and then pick funds, and then you will be disappointed because you'll always see that something which is done well, then again it is not do well. So let's say 2 years back everybody said quant, and today everybody is against quant, and then 4 years back or 5 years back everybody said access, and today everybody says access is lousy. So every fund goes through its cycle because there are different styles, and all styles go through periods where they do really well and they do really badly. So Naren, Prashant Jain, who were following value investing styles, were doing very, very badly till 2020 for almost a 3, 4, 5 year period. And then in the last 4 years, they've done extremely well. So the key is don't go only by the past performance, because then you will end up building a portfolio of only one or two styles. And then if the style reverts, then your entire portfolio will go for a toss. And again, you will catch the next past performing 2 or 3 funds. Then again, you will end up entering the next style at the end of its cycle. So the first key idea is you build it across different styles. So at Funds India, what we do is we split it across 5 styles: value, or contrarian as a style, which is the fund managers who pick that, who do that. You pick one of them, and then you take quality, which is effectively, they're saying I will compromise on the valuation, but I want top-notch quality companies which have decent growth. And the third is pure growth, where they say, I don't care too much on the quality. I will compromise a little bit on quality. I will compromise on valuation, but I want top-notch growth, which have highest growth prospects in the next 3 years. Then there is mid and small cap. And then the last one is momentum. So you put your core portfolio in these 5 styles and just pick one fund each. Then 60% can be going into this. The other 20 can go into global, predominantly US, probably NASDAQ or S&P 500. Then the last 20 can be used for your stock picking or for tactical bets. So in that way, you have a very simple portfolio, which it probably with 6 or 7 funds you are done. Then the last 20% you can use to do all your experiments. And if it is not working, you can put more towards core. And if it is working, you start increasing it. So I think this can be a good starting framework. But the key idea is do not go only by past performance. You should always have funds which are doing well and also not doing well. That will only happen if you start with styles and not start with performance. And two, do not have too many funds. I see most people having 20, 25 funds, which is in effect, it's almost impossible to beat Nifty, a passive index through 20, 25 funds. And the third part is that don't go by ratings. Ratings are effectively a replica of the past performance. So you'll never find a 5-star rating for a fund which is not doing well. It's effectively you sort it based on highest to lowest returns. The ratings will exactly match that. And the third important point is that all funds, even good funds, will go through bad times. So you need to identify, is it because of style or is it because of funds not doing well? Now the good part is that if you pick a style, you'll know that there are 3, 4 funds which are following the same style. And if your fund is underperforming, you just need to check the other 2, 3 funds. If those guys are also doing badly, then you don't need to worry. But otherwise, if you do not have, yeah. So that's the framework there.
Okay. So Arun, one more important thing, like majority of the time we see many participants talking about cash calls. So do you think cash call is something sensible, or does it fit anywhere in the framework you're talking about?
What is your view on cash calls? See, I am not a big fan of cash calls. Because again, the way I really think about it is that if you are taking a cash call, let's say you are a fund, you're taking a 20% cash call. The first thing the first logical question which I would ask is that if you are anyway collecting money and then you are saying that I don't find any opportunity to deploy. I think the first thing that I would expect that particular fund or fund house to do is to stop taking money, right? Then it makes sense. But to say that I will take money and then I don't have any opportunity to invest, but anyway, the 80% is invested, right? So and how difficult is it to add 1% more to the existing set of stocks and make it say 90 or 95%? So in a way, I think, and anyway, if the markets are falling, your 80% is going to fall, right? So this whole thing of this 10%, 15%, 20% cash calls, it almost is like a signaling tool, but otherwise it's not really going to impact the portfolio much. And at the same time, on one end, you are taking in money, but you're not deploying is a problem. I would rather like fund managers to say that today I do not have the opportunity. So let's say a lot of small cap fund managers did that even in last cycle and today's cycle, that I am not finding opportunities or I am finding it difficult, and hence I close my fund for further subscription. That is a lot easier, because then when somebody says no to new money, then it's a far more serious stuff, and that is a lot more easier as a call. So I'm not a big fan of cash calls, because net it's very, very difficult to time the markets, and if markets suddenly for some reason go up, you again miss the thing. And again, at 20%, like either way, you're 80% in, right? And it's not going to change your life in terms of the difference it will make. And it's not like anybody is invested 100% of the portfolio in that or in any one particular fund. Now, either way, it will be, let's say you are 70% equity, and within that, let's say I put 20% in that fund, and then it's only 14%. In that 14%, if you take 20% cash call, so you'll be roughly at 3%. Now at 3%, it really doesn't move my needle, right? So I think all these are unnecessary complications that are getting added. And at an aggregate portfolio level, if you really think about it, it just becomes noise. But personally, I am not a big fan of cash calls, whoever it is. But I think the better way is you either stop inflows, or you are finding 80% of your portfolio attractive enough to invest. So it's a lot easier to add 5% or 10% split across that 25, 30 stocks you have it in the 80% portfolio. So that's how I see it. But otherwise, as a negative indicator of the market, I'm not a big believer of that, and which is why I follow these frameworks. So whenever my frameworks tell that it's negative, then you get out of the market. But otherwise, you listen to anybody. There's a very, very high probability of going wrong. And I know a lot of fund managers were negative right from 2021. So if you had listened to them, you are out of the market. So I think it's always better that all of us have our own framework, and you use all the fund manager inputs or whichever inputs that come as one part of the framework, and then you see it holistically and take a call, because otherwise the market is very, very confusing, and the biggest mistakes will always be that we get out of a bull market a lot early and then miss out on the and as I told you, the odds are insanely by our side if we just hang on for 7 to 10 years. It's a very simple asset class that unnecessarily we end up complicating.
So, Arun, basis the broader sentiments you guys do rebalancing. So, may I know the frequency at what you prefer doing the rebalancing and how it help you generate alpha over the indexes to say?
See, broadly, the alpha over a pure equity index comes through. See, there are different levers that we have. So fundamentally, I told you, right, the 5-finger framework that we follow, that is like putting 5 funds together from different styles. So as I told you, we combine value, quality, growth, and then mid and small. And then, primarily it's mid cap, but again, it'll have 20-30% into small caps, because most mid caps will have it. And then the last portion is momentum. Then we have another 20% going into global. And then the last 20 is the tactical. But if you look at the 5-finger strategy, it's given us close to 21%. I mean, we started it from Jan 2020. So it's delivered close to 21% returns, vis-a-vis your Nifty 500 at close to 17.5%. And Nifty 50 close to 15.5%. And the best part is it fell lower than Nifty 50. So that 3 to 5% outperformance comes purely from the simple fact that you put together different styles. And the best part was every year it was not the same styles that did well. Every year it was a different 2, 3 funds which did well. And the best part is that even today we have two worst performing funds in the construct. And despite that, the overall strategy has delivered us a very, very good return. So this is a first lever that we use to build alpha. The second lever comes from the overall, and the second lever comes from the tactical calls that we do. And the third lever comes at the asset allocation front, where, as I told, if you blend gold and debt, and then again, if you can just rebalance for a 5% deviation, that in itself is able to, with much lower risk, is able to give you very similar returns to equity over a very, very long period of time. And then again, what we do is mostly 80% of the times we follow this as long as we are in a bull or boring market. The moment we get into a bubble market, we will try to reduce the risk from the equity portion. So maybe 10 to 20% of the equity we will move towards a BAF, especially a momentum BAF kind of a product. And then within the equity, we will again try to reduce the small cap, mid cap exposure. And then if there is any low quality exposure in any of the funds, we might want to reduce that. And then predominantly we will try to have a very large cap heavy portfolio. So overall, that's what we do for de-risking portion. And then generally we won't prefer any low liquid. I mean, let's say you're somebody who's looking at unlisted or very illiquid part of the market, micro caps and all that. We will completely want to get out of that. So broadly, the de-risking call will happen during a bubble market. And then at some point in time, once the bubble market gets into a crash, and the moment the market falls anywhere more than 20%, then we start investing from debt to gold. So, debt and gold to equity. There again, we have pre-made decisions. At 20%, what do we do? At 30%, what do we do? At 40, what do we do? At 50, what do we do? And after 50, you will run out of money to be invested. And then we start rebalancing within the portfolio. So just like how we went more towards large caps, after the 50% fall, you move more towards small caps, because you find that during the recovery, small caps almost end up doing 1.5x or 2x of large caps. So that is almost like within your portfolio, while you don't have cash, you're almost like adding new cash to equities at that level. So you have to start re-risking your portfolio. So that's how we look at both these cycles, and that's roughly added close to 1-2% over a long cycle. But more than the alpha potential from the asset allocation, we see it as a behavioral tool, because otherwise for somebody to live through a 50% fall for 2 years, 3 years is very, very hard. So people need, or all of us need, something to act, something to look forward to. So I think the idea is that asset allocation is our behavioral tool, while the broad equity is where we deliver the returns on. Once you combine that and you do it over a 10-15 year cycle, then the overall returns becomes very, very meaningful. And again, you are also saving. And the rough metric that we use is, if you can save around 10%, the portfolio can give around 10-15%. Roughly your portfolio will grow at 20-25%. And at 20-25%, you will double every 3-4 years. So which means, if you can double every 3 years, at a 10-year cycle, you will do 10x. Then again, if you can double every 4 years, in almost like 12 years, you end up doing 8x. So, and you apply this 3 doubles or 4 doubles over any decent portfolio size, it will come to a very, very meaningful number. So that's what we are attempting over a 15-20 year cycle. Can we help people build very, very meaningful amounts of money, so that the life gets a lot more easier for them, and they get to have a lot more choices. So that's the broad framework, Prince.
Perfect, Arun. Perfect. Love the explanation and the perfect framework. So, Arun, I think we are close to the end of the session. Questions, I think, more or less I've taken, but anything on the closing remark from your end?
No, I think that's the broad thing. I just wanted to say that it is a market which will be very, very confusing. So you will need to have very clear idea of what a bubble is, because every 3 months you will almost feel that it is a bubble, and there will always be something negative in the market. During COVID, it was almost impossible to imagine that the markets would recover so much. So at all points in time, so today again, cash calls can be seen as negative, promoter selling, PE exits can be seen as negative. But again, all this in context of all the other metrics look okay. But if these were these were combined along with all the other metrics also being negative, then so the idea is don't get misled by one or two metrics, but always have a holistic framework. And the framework that I had discussed, where you look at valuations, earning cycle, sentiments, demand and supply, and the triggers, is a lot more helpful. At least, I mean, we've done it for the last 5-6 years, and it's always helped us become a little more rational and to cut out noise. I'm not saying this you have to use it like that, but whatever feels right, you can use it. But try to build your own frameworks, because otherwise everybody will keep confusing you with one metric or the other, and it always leads to a lot of people calling out for a bubble in the middle of a bull market and missing the bull market. And the same thing can happen the other way around, where you misdiagnose a bubble market to be a bull, and you don't de-risk your portfolio. So I think this whole, if you can just get a good sense of the cycle, all the other stuff can be all the other stuff is secondary, because once you get the cycle right, then a lot of your returns and your alpha will be made through that. And in terms of the fund selection, if you can just diversify across 4 or 5 styles, it gives you a very, very, very good experience. And the idea is, with the least amount of effort, how do you make a lot of money over an entire 10-15 year cycle? And most importantly, don't forget the fact that your savings as a portfolio is an important metric to track. I see a lot of people not tracking that. And the last part is, if you're a DIY investor, please make sure that you are also comparing yourself with a benchmark, and without any biases. Just see if you are doing well or not. If you're not doing well, it's okay. Like, then life can be a lot more easier, and you can outsource it to a good fund manager. So yeah, that's broadly a few things that I thought I'll sum up the session with.
Thanks, Arun. Thanks a lot. And for our audience, those who are joined Arun for the first time, he has authored a very good book, The 80/20 Money Makeover. So definitely, what you heard today, there is a lot more into that book, and definitely you'll cherish and thank me later for that. So definitely, if you haven't got your copy, please do that. And this session is recorded and very soon will be uploaded on the YouTube channel. So I hope those who joined late can listen over there as well. And I think it will be available on Arun's Twitter handle as well. So please feel free to listen to the recording. And really, really helpful, Arun, as you rightly said. Every 3 months we are getting a feeling of negative market and more of a confusing market. It's so good to listen your thoughts and basis those lenses and the framework which you use. So really, really helpful, and I hope everybody in the audience enjoyed listening to you and have benefited a lot, especially cutting down on the uncertainty. Thank you so much. We'll surely connect again. Lovely interacting again.
Thank you, Prince, and thank you so much, everybody. You've been a very, very kind audience, and you've stuck on for so long. And I'm really sorry that the first half an hour there was a lot of goof ups from our side. I don't know what happened, but